Good afternoon from the San Francisco Bay Area. I'm Jason Putnam Gordon, and welcome to today's Idea to IPO event, which is hosted in large measure by my law firm, K&L Gates. Today, we're going to talk about how to position your startup for venture capital funding. It's an exciting event. We're going to get started on the sort of meat and bones of today's conversation. But before we do, I got a couple notes for you. First of all, as you could probably tell, if you've entered the room a couple minutes before we got started, I'm going to be running all the tech in the background. So I'll be presenting and doing that. And I can do both, but I have got limited bandwidth to monitor various windows and other things. So that's a long lead up to say, if you've got a question, please use the Q&A function. Don't use the chat function. The chat function, feel free to communicate with the other folks in the room. Q&A is the way to go if you want to reach out to me. Now, additionally, as I mentioned, today's event is recorded, which is exciting. If you miss some or you miss all of it, so long as you have registered, we will be providing it to you about a week or so afterwards. We've got the intervening holiday, so bear with us as we do that. Please do not share any confidential information with me. I'll probably repeat that a few times throughout today's conversation or the presentation, but don't want to have that, and certainly don't want to have it in this forum where it's being recorded. It will exist, potentially forever on the internet, and it's a public venue. Now, one other request, I've got an audience survey that is up and running. So please fill that out. It's helpful to get a general sense for who's in the room. When I used to do these events in person with Idea to IPO, stemming back to, 2012 or 2013, we'd always do an audience poll, and I'd, ask people who were there. It's a little bit harder to kind of have that back and forth dialogue in this venue, but it's still really helpful. So with that in mind, let's kind of continue on with the caveats here. So there are a few important caveats to keep in mind, okay? Today, we will be discussing rules and exceptions to rules and exceptions to exceptions. So this is not to be taken as legal advice to you in any sense. It is meant to be general information to give you some guidance for, how to think about approaching the venture capital ecosystem, how to build and grow your startup. That is what today's event is about. Now, if you want to have legal advice, go out and retain an attorney who practices in the emerging growth and venture capital space. That's what you're going to need to do, because that person will need to ascertain all the facts that are relevant and give you that advice. So off the cuff answers today, or I do keep office hours. I'm interested in having a conversation, during those office hours, especially if you can't answer your questions today, for either because they're not of general applicability to who else is in the room, or because it would kind of take too long to explain. Happy to have those office hours. You can see you can connect with me on LinkedIn, or my email is also in the name there. But again, even those office hours, I don't want any confidential information, and it's going to be general advice. Now, so with that in mind, and we may repeat some of it, let's continue on. So here's what we're going to do today. I'm going to speak for about an hour. Throughout today's conversation, I'm going to pause kind of as we move through different topics and try and answer questions in the Q&A function that are appropriate for where we are in our discussion today. Probably won't get to all of them at that point in time, in which case after about an hour, we'll just have about 25, 30 minutes of Q&A at the end. And again, things that, questions that don't get answered, feel free to connect with me, and we'll try and set aside some time to connect. So, we're going to talk a little bit about my background, who I am, why I'm talking about what I'm talking about, why you may want to listen to me. If you've got other opportunities of what to do with your time, I respect that. We'll talk a little bit about who's here. That's when we'll go through the audience survey, get a sense for who else is in the room. We will talk about the structural considerations of, how are venture-backed companies typically set up? Why is it in that format? We're going to talk about documentation surrounding that, basically what it is that you're going to need or want to be thinking about to get yourself into a position to raise venture capital funding. Now, remember, this is a high-level presentation, and it's from a legal perspective because I'm a lawyer. So We'll touch a lot, I think, on the business aspects, but it's really geared on a legal perspective or framework. One other thing to keep in mind, venture capital is a means to an end. It's a means to an end of growing a large business, a particular kind of business, and we'll talk a little bit about that when we talk about what VCs are interested in. It's not an end in and of itself, but the way I generally think about things, especially the older I get, is try and figure out where it is you're trying to go and then work backwards. And this will hopefully give you a framework as to what that path looks like from a legal perspective. So in line with that, we'll talk about the mechanisms for those early rounds of capital. We'll talk about issues regarding valuation and dilution, and why you need to run pro forma cap tables. I've got a separate pro forma cap table presentation. I feel like, dilution and running pro forma cap tables is just such a critical component to, growing a successful venture-backed company that we're not going to be able to do it justice in today's conversation. But on those other presentations, I think it's so critical, because as you're raising capital, you're essentially selling a piece of the company. And in order to, make sure that you're pricing the company correctly, you need to know how much you're selling, and you need to know what that looks like over the successive rounds of capital you're going to raise. And, we'll talk more about that. And then we'll talk about sort of an overview of what goes on in a venture capital financing, because again, we're sort of focused on how to position your company, which means you need to, getting up into that point. The actual negotiation and how to sort of do a venture capital financing is a different presentation, which I think I'm doing on the 13th of January. Bear with me. Great. I think I hit mute just in time for that sneeze. And then we'll talk about common pitfalls and other traps. And I've got a long list of those, and we'll try and get through as many as we can. So I'm going to end the survey and just sort of share who's in the room. And we've got a great turnout today. So I am really excited. Thanks for coming in. Thanks. I hope you stay really engaged today. That's my goal. Use that Q&A function if you've got questions. And if you got feedback, use the Q&A. All right, so we got roughly 16% of the folks from Bay Area, 11% from California, from elsewhere in California. So we got about 27% in California. We got another 40% in the US. So looks like we got a pretty US heavy audience today. We got some folks in Europe, roughly 15%, 5% Asia, 3% in Africa, 1% Australia, and then we've got a couple people in other places, maybe in the Middle East. Now, again, this is recorded, and so as a result of that, a lot of people watch it asynchronously. So for those of you who are watching it asynchronously, thank you. We've got over 50% first-time entrepreneurs. Terrific. I think the sort of first-time entrepreneurs who are raising and running venture-backed companies, they're going to get probably the most out of this immediately. And then we've got a bunch of serial entrepreneurs. I will tell you, whenever I speak to people who've come out and this is their second or third sort of startup, they come to one of the programs, they say they get a lot out of it. We've got some angel investors, some folks in academia, and we've got some folks at early companies and some folks at mature companies. So thank you. A little bit about myself, as you can see here. I'm an emerging growth and venture capital attorney. I am with K&L Gates, which is a fully integrated, full service global law firm. Okay, what does that mean? It means that we've got over 40 offices on 5 continents with over 1,900 attorneys. We've got a deep history working in venture and tech. And I myself have a bit of an entrepreneurial bend. Before I sort of returned to big law, I started from scratch with no clients, which is not really the way to do it, my own boutique, focused in this area, and grew and ran that for about 5.5, 6 years. So I find that resonates with my clients. I also find it helps me be a better advisor to them. We went over the audience survey, and let's kind of dive into the meat of things. So structural considerations. Well, let me not bury the lead. Typically, venture-backed companies end up with a Delaware C-Corp. Now, let me explain why that is. So that's kind of the left side of the slide, and then we'll move over to the right side, which I've already talked about a little bit before. But whenever an entrepreneur comes to me and we're talking about creating and forming a new business, I sort of have a matrix of issues that I think about and run through with that person, and typically it shakes out in one direction. That is that Delaware C-Corp for a company that intends to be venture backed. And then it can go other directions for other types of businesses. But, we think in no particular order, because it varies for each business. The sort of 6 or 7 things that we think about are the tax impact. What's going to be an optimal tax structure for this entity. We talk and think about what the personal liability or the liability exposure is, and the shielding that you want to have, maybe between either the owners of the business and the operating business itself, or between different lines that are operating sort of within the business. We talk and think about the ownership structure and equity grants, who's basically going to be on that capitalization table, that cap table, which you'll hear us refer to. From an ownership in terms of entrepreneur perspective, as well as service providers. Those are, advisors, consultants, employees. We think about the capital raising requirements. That is what your investors are going to expect to have and why they have that. We think of, sorry, I need to not look at the chat function because it's a little distracting. We think about management structure, okay? And that kind of dovetails a little bit with capital raising requirements insofar as you've probably heard, if you've been interested in this space before, usually VCs, whether they're a traditional fund or even a strategic, are going to want to have somebody on the board. And so what's that management structure going to look like? We think about what the exit of the company is and what the horizon of that is. And we're going to talk quite a bit more about that when we talk about sort of raising capital and who are good investors. And then we think about the regulatory framework. So there are some spaces that are highly regulated, healthcare, sort of finance, if you were going to go into the utility space, things like that. And those, the regulations can impact the structure. But, coming out of that many times, especially if you're not in a highly regulated space, you're going to end up with a Delaware C-Corp. And let me explain why. Delaware, because they've got some of the, they're known for having the best, most sophisticated corporate law that's out there, which includes having more liability protection for its directors and officers. Again, earlier, we mentioned how VCs are going to want to have a seat or two, or it sort of depends, but there are going to be a few seats on the board. So they want to be able to insulate their people and insulate their fund as best they can. Delaware's got the Delaware Chancery, which is a sophisticated court that hears a lot of business and legal issues. And the issue here, or the advantage here, is that uncertainty can be problematic in business. If you've got a court and robust case law where a lot of business issues and disputes have been decided, it's more likely that someone else is going to have the same issue or dispute that you have, which will hopefully provide more certainty as to who's respected, what the rights are among the parties who are in dispute, which will hopefully resolve them more quickly. And the court is known also for being expeditious and coming to good and appropriate sort of outcomes. And then the Delaware Secretary of State's office is pretty awesome because it processes paperwork pretty quickly and professionally. And sometimes in other states, you can end up in a situation where there is a non-lawyer person who sort of receives the paperwork and doesn't process it because they're confused about an issue. And that can be a real deal killer, or certainly run up a lot of legal fees trying to work through an issue that shouldn't be one in the first place. In terms of why it typically will end up in a C-Corp, that's because of the investor base, right? We went through a matrix of 6 or 7 things, but I mean, here's kind of what the issue is. And we'll talk more about funds, but in a little bit. But if you're going to be pursuing venture capital, the traditional venture capital funds are set up as limited partnerships. Those are pass-through entities, which means that the profits and losses get passed through to the partners, the investor base. And so when they invest in companies, they want to have a company, they want to make investments where those taxes are not passed through until the time of an exit, right? So if they've got a portfolio of a lot of companies, and we'll talk more about this in terms of what their portfolio looks like and what they're looking like later, but if they want to have a portfolio of companies, they don't want all the losses getting passed through all the time, especially during the life of the fund. It would be a tax and accounting nightmare. So that's basically why you end up with a Delaware C-Corp most of the time. If you set yourself up with something else that can get fixed, I often get the question of, well, what do I do if I set myself up with an LLC? And many times that can get fixed or remediated. You know, sort of the earlier you catch it, the easier it is to flip into a C-Corp, assuming, again, you've run through the matrix and things are right. But, you know, even if it's a bit later, it's not per se an intractable problem. It can be if you can't get the various stakeholders to agree to it. And it can be, you know, in the flip itself, especially a little bit later on, if you've got parties that are in dispute as to what they want, one party can use it to leverage it over another party. So best to kind of get things set up properly from the get-go. On the right side, you'll see, you know, what is the sort of common path for venture-backed companies, right? So they start off just a group of founders, maybe it's one founder, maybe it's a few founders, start to assemble the initial team, start to build an initial product or service. And that's when they're raising seed capital from the 3 Fs, which are friends, family, and tongue-in-cheek fools. And we'll talk later about why you don't really want to have any fools on your investor base, because you don't want to have unhappy investors later be a problem. But that's when you're raising the sort of first rounds. Typically, you know, in the Bay Area, you know, first few million are done sort of the seed stage. Can be different in different geographies, you know, whether that's elsewhere in the US or international. I do a fair amount of cross-border work. But that's that's the sort of general thought process, is that initial team build out, initial product putting together, maybe the initial sort of go to market, testing in the market. And then once you kind of hit that point, you know, you hit that first blue dotted line right here, that's your first funding. And typically it's either called a Series Seed or a Series A. It's a branding thing as to which way it is. Maybe we'll talk some more about this a little bit later in the program, but that's what we're set up with. That's how it goes. And, you know, the path is, you know, over 7 to 10 years, the company's going to grow and scale and then have an exit. An exit is a liquidity event. That is, you know, the opportunity for folks on the cap table to get cash, get liquid. And you're going to raise successive rounds of capital based on hitting certain milestones. So that's going to get baked into your business plan. And we'll talk a little bit more about the business plan a little bit later. Yep, it says the slides are not progressing. Is that, it should just, we're just looking at the startup financing cycle right now. I hope that's what everybody can see. All right. Now, some other structural considerations here include just making sure you've got the documentation and paperwork correctly from the get-go. So being a lawyer, one of the things that I always think about is that, go back to sort of initial corporate law class, and it's like, corporation is really just a bundle of contracts, a bundle of rights. And so it's making sure from a legal perspective, you know, what we're looking for is making sure that all of the things of value and all of the obligations, right, all the assets and liabilities have a contractual tie to the company. So startups are about people and IP primarily, and then ownership, who's got the right kind of ownership of that. And so that's what it's all about. It's about making sure that there are the right kind of IP assignment provisions. There's the right kind of, so all the IP is getting up and into the company. It's about making sure that all of the consultants and employees and other working relationships, have the right kinds of agreements in place so that, it's clear, so you're not accruing wage and hour and other sorts of issues. It's about, to the extent somebody has an ownership interest in the company, that gets papered properly. So when we see founders and early employees, we see them typically having most typically restricted stock. So that's stock that's subject to vesting. And then a little bit later on, probably after you've done some convertible notes or safes, and we'll talk about them in a little bit, we'll see stock options being used. But it's about making sure those are papered properly, and about making sure, especially for those founders and those early employees with restricted stock, making sure there's vesting so that if somebody were to leave, they don't walk away with a huge chunk of the company. And then it's about also controlling or making sure that there are some checks and balances, some controls over the transfer, over who's on the cap table. So that's what we talk about in terms of transfer restrictions. And those can reside in, in the stock purchase agreements. That's where the sort of restricted word comes into restricted stock, in bylaws, and then other various shareholder agreements. So let me pause here and take a look at some of the questions. Is there ever a scenario where the founders want to keep the company entirely private and never go IPO? Yes, absolutely. I guess the way I would answer this is, if you want to raise venture capital, well, we'll talk about a little bit more about them later, but they're looking for an exit. They're looking to get liquid at some point. And so, if you're going to never go private and there's no way for them to get a return on their capital, it's not going to be an attractive investment for them. Now, that being said, most venture-backed companies don't IPO or SPAC. They will end up going an M&A route. And so they may stay private, or they might get sold to a publicly traded company. We can talk more about that later. If someone's got an S-Corp and they want to know, and now they're interested in pivoting to be VC, and they didn't incorporate in Delaware, happy to connect with you. That question is going to be a little bit longer to give you a general sense as to what we would work through or think about. What percentage of the deals do I see are safes versus convertible debt? We're going to talk about that in 1 minute, but let me just sort of suffice it to say, the way I look at it is kind of where you are in the company's life cycle. So if you are at the sort of seed, building out the initial team, initial product stage, and you're raising, a few million, up to a few million, safes and convertible debt are very, very popular. You're raising kind of less than $1 million or $2 million. I certainly less than $1 million, almost exclusively see safes and convertible debt. You're raising $2 million. Maybe we start to turn out, we see some equity, some preferred stock being issued. You get up past $5 million, it sort of starts to tip in the other direction, while I see more price rounds, more venture rounds, but still see a lot of safes and convertible debt at that, even with that amount. Do you suggest starting the company as an LLC and converting to a C-Corp when ready to go for VC funding? I will tell you, there's a philosophical split between me and some of the other people I have worked with in the past. So that is open to interpretation, and one where there's a little bit more art than science. I think it's always sort of best to just get it set up the way you want to head from the get-go. I think that's the way most of the folks are in the Valley, like me. But folks outside the Valley love to set up LLCs and then flip them. So, or depending on the situation. All right, let's keep moving on because we've got a lot to talk about. So those early financing options we're talking about are really going to be safes and, convertible debt or convertible equity. Now, convertible debt is also known as bridge notes, and convertible debt is kind of the parent of convertible equity, and convertible equity is more frequently called safes, a simple agreement for future equity. and Y Combinator developed the SAFE. We'll talk about what are in some of those in a minute. And then the other mechanisms are more like a traditional venture round, which would be a price round where you actually put a price on the company and you issue preferred stock. So, the things to keep in mind, we were just talking a moment ago about percentages of deals and where that is. Convertible securities are used to avoid having to value the company at such an early stage. It's very difficult to assess what the value of the company is at a very early stage because there's a lot of risk and unknowns. What does the market really look like? Or is the team going to be able to execute? Are there going to be other competitors in the space? If you are an entrepreneur and you set the price too low, then you're selling too much of the company. Conversely, if you are an investor and the price is too high, then you're buying too little of the company for your money. So the thought process is, let's give the company some, not give the company some money, but, let's invest in a company and let's delay the issue of valuation until the company's at a better point where they actually start to see revenue, right? Which is what you typically start to see when you're doing like a true venture deal. Another advantage is these are typically less expensive to do than price rounds. There's less to negotiate, less lawyer time, less fees, less diligence. So downside, especially at least for convertible notes, is that those, as we'll see in a second, are instruments that actually have debt associated with them. So you got to pay them back. And so they'll come due on a maturity date. And if you don't have the capital, you could theoretically get forced into bankruptcy. And this is maybe more of an esoteric issue for most of the really early stage companies, but convertible notes are debt. And so if you think about the liquidation preference stack, that is who gets paid first if the company gets wound down, they will sit above the equity holders, whether it's common or preferred. So that's something to also think about. So with that in mind, let's kind of hit on what the sort of typical, and there's a separate presentation that I do just sort of on safes and convertible notes. But this is just the sort of high points, right? So what I'm trying to do is just, again, let you see what the path is so you can get prepared to raise venture funding, not necessarily drill into any one of the specific points on the path. But I think it's important to understand what these instruments have. So they've got a maturity feature. The convertible debt has a maturity feature and also has an interest rate. So it'll accrue interest over time, just like your credit card would accrue interest over time, or your car loan would accrue interest over time, or your home loan. And then they both, whether it's a convertible note or a safe, have a conversion term. So we'll talk about what that is, but the mechanism is really focused on when does it flip over into equity? And more specifically, when does it flip over into preferred stock? And then one of the other really important things to make sure you've got a good mechanism built in on your convertible note or your safe is just the ability to amend these notes or safes using a majority in interest. That is, the majority of whoever's holding the outstanding principal, because you may need to have the deal recut at some point, right? If it's because you're coming up on a maturity date, you may need to push back that maturity date. If it's because, the investor, I don't know, you raised on too many convertible notes, and let's say the discount was too high or the cap was too low, and the founders are going to take some sort of bath or something, and the new money won't come in without there being an amendment. You don't want to have to go out and get each safe holder or each convertible note holder their permission to change that term, because otherwise that can kill your deal. You want to have a mechanism that makes it basically fair for everybody, as long as their interests are aligned. Now let's talk about the conversion feature, because again, this is about getting you to be, getting your company set up to get to a preferred funding, right? And so this is about raising that sort of first round or a couple rounds of capital to get you there. And at the heart of it, it's about using some sort of, or maybe two mechanisms to convert that money that the investor has put in into shares of preferred stock. Now, one which you've heard me mention both of them already, a discount and a cap. The discount is a mechanism that basically gets applied to the price per share that the preferred is going to pay. And it allows basically some bonus or extra shares to go to the convertible note holder or the safe holder. A cap is a mechanism where if it's triggered, you ignore whatever the pre-money valuation that that the venture investor has put on the company, and you use that number instead. And these two things usually, or many times, work together. We typically see, it's very common to see convertible notes or safes with both a discount or a cap, and the investor, that is the holder of the convertible note or safe, is going to end up with a number of shares, the greater number of shares if depending upon whichever is applied, right? So you run the math on both of them. And if the investor is going to get more shares, greater number of shares off of the cap, that's what the investor gets. If the investor is going to get the greater number of shares off of the discount, that's what the investor will get. Now, sometimes we also see conversion mechanisms come up in changes of control, that is like a sale of the company, or also in a maturity conversion. But the most of them are really focused. One that we would always expect to see if there is a cap is one that would be applied in the event of a qualified financing. That is, if a certain amount of money is raised, typically in a preferred stock round. So I'm going to pause there and see if we can get a roadmap. Sorry, I'm just kind of looking through questions to see if there's some of general applicability to where we are. There are a lot of great questions, but I think I'm going to hold these towards the end. Okay, great. I'm going to hold these towards the end. What I want to do is I want to take what we just talked about in terms of safes and convertible notes, and I want to apply it to just give you some basic examples. And then I want to take that information, I want to build upon it, and I want to talk to you about kind of what you need to think about as you're going into raising a price round, that is preferred financing. So the concepts you need to keep in mind here, I already mentioned one of them, pre-money valuation. That's the value of the company immediately before the new money, that is the venture money, comes in this case. That would typically include the money from the safes or convertible notes in there. The post-money valuation is the value of the company immediately after that new money comes in. And fully diluted basis is typically thought of basically all common stock that's issued and outstanding. That is like all the stock that the founders have or the other employees have, plus all securities that can be converted into common. So that's typically including the conversion of the safes, including the conversion of the convertible notes, plus the shares that are reserved under the equity compensation plan, right? We talked about options a second ago. Now, I say typically thought of for each of these things because it's one of these things where there's a general sense in the industry as to what each of these things mean, but you always got to read the fine print because they're defined differently in different places. And they're even defined, the definitions change over time. So like the old school safes are different than the current safes when it comes to looking at fully diluted basis. And in fact, actually, they don't use that term. It's the company capitalization. But I'm just trying to familiarize you at a high level with the concept at this point, not drill down into the minutia, which I can do. Another point. So let's just sort of take it at a very simple example. Very simple. We're not going to even include an option pool or anything else out there. And the math and the numbers used here are really just for illustrative purposes. You wouldn't necessarily set the company up exactly this way. And I saw somebody had a question kind of about share numbers before, and we can maybe talk about those a little bit later. But let's just say you had a company where there were 10 million shares that were split among 3 founders. Now, of course, they've got vesting in place, which is great. And we can talk a little bit more about vesting if you all want. But at that point, at the outset, and let's say a VC comes along and say, "Oh, you're doing such a great job, great team, great product. See that you're starting to get traction in the market. See, really, what's holding you up at this point is that you need capital to scale, build out your sales team, to increase your manufacturing process, whatever it is. We think your company is worth $10 million before we put in our $3 million. Okay, so the pre-money valuation there is $10 million. And the post-money is that $10 million plus the new 3 that will come in, and that is 13 million. I can do math, it's on the screen. So what would happen there is the VC would pay $1 a share. They would take the pre-money valuation, which is $10 million, divided by the number of shares that are outstanding. And again, we're ignoring option pools here, getting those in place. We're ignoring that there are any safes or convertible notes. We're pretending there aren't any. So the VC would pay $1 a share. So the founders will have gone from having 3,333,333 shares, or 33% of the company, to roughly 25% of the company. That's 3,333,333 over 10. Excuse me, over 13. Over the 13 million shares that are now outstanding. But you'll see, when they first started the company, they had that 3,333,000 shares, but it wasn't really worth. Who knows what it was worth? It's probably worth very little. They probably paid just over par or just over par for it, just some nominal amount. And now they've got their shares, at least on paper, are worth $3.3 million. Now, just to sort of apply it in a very simple sense, and again, I've got a separate presentation, which I do, that actually kind of breaks down the math and goes into Excel sheets. But I just want you to see kind of how, at least in concept, how the discounts and the caps work in these situations. So we're going to ignore some of the circular math that goes on and that we work through, and there are mechanisms to work through in this first situation. But if we were just looking at a discount situation, and we'd said, okay, the VC came up and they were going to pay $1 a share for their shares. If we were to apply the discount, you'd see then that the convertible note holder or this convertible security holder would actually only be paying 75 cents a share. So that person will get their $450,000 worth of convertible security converted at 75 cents a share and end up with 600,000 shares of shadow shares, which are shares that are basically almost exactly identical to the shares that the new money are getting. But it takes into account they've only paid 75 cents a share instead of $1 a share. So the liquidation preference is going to be 75 cents instead of $1. The dividend rate's going to get adjusted. The anti-dilution rate's going to get adjusted to account for that. In a cap situation, if there had been a $5 million cap on this company, again, same $450,000 convertible security. Again, at the outset, I said, in a cap situation, when you're up past, when you're significantly past, when the pre-money valuation is significantly past the cap, you ignore the pre-money valuation. And when you do that in this situation, you see that shares actually convert at 50 cents a share. So that convertible security holder is going to get 900,000 shares. So you can now see how that starts to really impact the percentages that the founders are going to have. Now, again, these are simple, but the point is you got to run pro forma cap tables. And we'll talk about that in a minute. And you got to understand what you're selling when you're selling it. Now, let's talk a little bit and give you an overview of venture financings, right? So today's goal is to, give you a sense for how to position your company for a venture capital financing. So I'm kind of trying to take you all the way from incorporation at a high level through your initial rounds of capital raise, which we've talked about, to the venture financing, where you need to think of, these are the things you need to think about. And then we'll talk at an even higher level about what happens in venture capital financing. But again, it's about getting up to that venture capital financing. I believe on the 13th, I'm doing a presentation on how to actually do a venture capital financing, and love for you to attend. So here's, I think, the takeaways, the things that I thought about this again this morning. I want you to have a credible business plan when you go in and before you start the pitch, before you even start that. Now, this plan may or may not be fully written and fleshed out. In very early stages, especially if you're raising safes and convertible notes, other things, it sort of gets presented in a slide deck. But some of the real key takeaways when I say business plan, I'm thinking about you as an entrepreneur really being able to understand your market and articulate your vision, understand and be able to articulate your go-to-market strategy, how you're going to be able to execute on that, the time frame it's going to take for you to build and scale your company, your capital raising requirements, and then also have you think about those milestones along the way, right? And if we think back to those really much earlier slides, you raise successive rounds of capital tied to milestones, right? So, we're going to raise $5 million in this venture round because that's going to allow us to do X, Y, and Z and scale to this point in revenue, or land these, or it is land these marquee customers, at which point we will be able to, leverage those relationships. We will be able to leverage the cachet that they give or whatever it is. I don't know. I'm not running your business. And we'll be able to take it to the next level, but we'll need to raise at that point 15 million or whatever the number is, based on a plan, so that we can hire these people and we can develop this technology. That's what I'm talking about in terms of a business plan with milestones, because that's what you're selling, right? You're selling a vision, especially those initial rounds of capital and the initial venture rounds. You're selling a vision of your company to an audience, right? To the VCs. And we'll talk about what they're looking for in just a moment. You also need to be able to understand the risks that are presented to your business and the plan and articulate them, because these VCs are smart. They didn't get in this business because they're foolish. They're frequently, many times, previously successful entrepreneurs. And so they know what it's like. So the risk of your plan, right? What's the technology risk? Are you going to be able to build that? Are you going to be able to scale that? Even if you can get sort of a prototype together, are you going to be able to get it manufactured? Are you going to be able to scale it? Are there IP risks that are associated with it? Is someone going to come out of the woodwork and think, oh, well, you're infringing on our patent, so we're going to be able to shut you down? The market risk, what is the risk that those customers that you think are going to be interested are going to disappear, right? What's in vogue changes, especially if you're kind of on the consumer side of things, right? Regulatory risks, right? So I mentioned before, I do a bunch of work in the sort of healthcare and life sciences space, also fintech from time to time. Those are highly regulated environments. So it doesn't just have to be those, right? So if investors, especially VCs, once you get to that level, are very attuned to these things, so you're going to show much better if you can articulate what they are and what your plan is. Now, they may or may not agree with you, but at the very least, you should be able to articulate your vision and have a business conversation or discussion about it. Maybe they persuade you, maybe you persuade them. But, and there are strategies out there, which is, sort of capture market share, build a lot of interest, and then put that on pressure to change the regulation. And if that's your strategy and you think that's going to work, then you'll articulate it. But that being a default strategy, may or may not be particularly persuasive to a specific VC. So you kind of got your business plan together. You're interested in raising capital. I think it makes sense to run a systematic process. Now, when I say that, I mean, I'd like it when my clients have more than enough capital from their early raises, because they've thought ahead, when they're doing their convertible notes and safe raises, so that they've got enough time to run a process. Thinking you're going to be able to raise venture capital in 3 months is probably not realistic. It's probably closer to 9 to 12 months, from when you, or more, from when you really set out there. Now, part of that's going to depend on, hopefully, you've been in and are in the space for a while, and you've taken this opportunity to know who the players are, and you've started developing relationships with VCs before you've even needed their capital, before you need to make an ask, right? So they get a sense to know who you are. They can maybe see what it is that you're working on. Maybe they sometimes even will kind of take you under their wing and or give you some feedback. Whether you do that or not do that is kind of up to you, has its own sets of business risks. But sort of from what I have seen, randomly cold calling VCs is not, especially at the early stage, is not what's going to get you there. There are a few things that will work well. Having customer traction, that customer pull, sometimes people call it, that gets their attention. Having already sort of started to develop relationships and knowing who the players are in the space and getting a warm introduction will help it so that they will pay attention to you. You'll get a meeting that, if you do get a meeting, someone will be paying attention to you. And again, getting the right sets of angels and other investors in place are kind of immensely helpful early on. You do not want fools on your cap table. You want accredited investors who, have maybe worked in the space, can open the doors, understand your business, and, potentially provide introductions and are patient, because it's tough to build these businesses. Now, when we think a little bit more about this particular sort of audience, when we think more about this audience, a traditional VC fund is set up where, as a limited partnership. And those investors in that fund are called limited partners or LPs. And they are, have a set of expectations. They have a set of expectations that if they give, if they invest their money in a fund, they'll get a return, which is, I've heard it be sort of maybe around 3x over the life of the fund, which is about 10 years or so, something along those lines. And the strategy that most VCs employ, especially sort of earlier stage VCs, traditional VCs, is they make a lot of bets. They build a portfolio, and there are going to be sort of many losers within their portfolio. Those are companies that really kind of don't go anywhere or go under. There'll be some companies that do decently well. Those are singles. They'll have a decent exit. And then there'll be a couple big winners that will basically return what the fund needs in order to get, the return on the fund, basically. And those winners, are sort of typically seen as doubling or tripling in value every 18 to 24 months or so. So that's kind of what they're typically on the lookout to see. Every fund has got a different investment thesis. You can typically look up some of the funds. Many of them will sort of disclose what they are, and they'll disclose what specific space they're in. But I mean, you could see with those types of rates of return, if someone invested in a sort of series seed price round, $1 million, and they sort of doubled or tripled every 18 to 24 months, there could be a 20, a 30, or even a greater return than that. So that is typically kind of what they're looking for. And they're looking for a credible business plan that's going to be able to do that for them in that time frame. That's sort of seven years or so. If you got a play that's 20 years, it's not really for a VC. Now, strategic investors are moving more and more into this space. And they've got different things that they are looking for. Sometimes it's just sort of a capital or a money return, but many times, they're looking to further develop the market for their products, right? They want to see a bunch of companies that are out there that will they will seed those companies. So they'll use their platform or they'll buy hardware, right? From those folks, like if they're a chip developer or something, right? They'd like to see a lot of companies out there that have hardware that needs their chips, things like that. Other times it's part of corporate development, right? So what they want to do is they want to get talent or technology or other things into the company, or just maintain their market position and relevance. So understanding who it is that you're pitching to is critical, because you're essentially making a sale. You're selling your vision in a company so that they will buy your vision in the company and actually tangibly buy an ownership interest in your company. Now, where are we on our slide? Have enough early capital, get your plan together, run a systematic process, have enough capital in there, connect with the right investors. I think we talked about that. We've also talked about what investors are interested in. Understand your ideal term sheet. We're going to talk about that on the next slide. And then get prepared to go through thorough diligence, especially when you get up to that price round. Lots of times in the sort of seed stage, you can now I'm not saying it's the right way to do things. Wouldn't say that, but I will acknowledge it's how it gets done many times. Companies, employment and contractor relationships are not as buttoned up or not as good as they necessarily should be. The customer contracts are not as sophisticated as they will ultimately become. Maybe they, you haven't kind of maintained the appropriate level of corporate governance and diligence or governance in place. All of that is fair game for diligence, right? So what will happen, and we'll talk a little bit more about this later, but the VCs are interested in, getting up, picking up the upside and mitigating the downside. So the diligence is the process where they look under the hood and sort of assess, do a risk assessment. Well, it's two part. One, suss out the plan, see if it'll be able to pick up the upside, and two, do a risk assessment. So be prepared to have a thorough process run, and we'll talk about what it means to prepare and what we'll see after the next slide. And be prepared for cleanup, and be prepared to have it be more buttoned up going forward. And then, understand what your ideal term sheet is. How much of the company are you looking to sell? That's critical. What is the dividend that you're looking to negotiate? That's true. That's not necessarily like a big sort of deal mover these days, but it's in there. Liquidation preferences, understanding what's market for that, all of these various provisions. You're going to see in a second, I'm going to share with you some resources, but thinking about what your ideal term sheet is going to help in you thinking about that in advance of sort of initial even discussions with VCs. I think will, one, hopefully give you a better sense for what that market is, what the market and the appetite is for your company and the terms that you want to get. And two, I don't know, but for whatever reason, when I find when I sort of plan in advance and sort of set out what I'm looking for, it's much more likely for it to show up. I don't know why that is. It just sort of seems to be that way. Now, how do you get a sense for all this? Well, believe it or not, I mean, if you've got the right counsel or you've got the right advisors, many times they're plugged into the ecosystem, and they've got their own set of deal experience from which they can draw those of their colleagues, plus there are outside sources, PitchBook, Crunchbase, other sorts of things where you can get market data to start to get a sense for kind of what's market or what's normal. And let's just do a high-level overview of the venture financing process. So diligence, we mentioned. What does that mean? I said, oh my gosh, it's going to give you such thorough and exhaustive diligence. There will be a request that's, I don't know, a few pages long, where they will want to see all of your corporate records, all of the stock issuances, all of your board minutes, all your stockholder minutes, et cetera, et cetera. all of your material customer contracts, all of those contracts that are important to your business or company, all of your contractor agreements. They'll request to see any litigation you have or any threats of litigation you have. All of your IP needs to be listed out and sort of described, certainly at least registered IP. That is patents and trademarks and other things that are actually registered. And sort of the list goes on and on and on and on and on. And, all that typically gets put up into a virtual data room where they and their lawyers will take a look through it. Now, again, I'm sort of focused on the legal aspect of all of this. There is other business diligence that happens and occurs, conversations with the founders, review of your business plan. Sometimes there's even customer inquiries, right? If you get kind of not late enough, but if you get far enough along in the process, it's for them to assess, what is the likelihood you're going to sort of be able to hit, achieve your vision, and, what are the risks to achieving it. Now, the documentation process, you normally start out with a term sheet. It's great. In the last 8 years or so, things have continued to become even more and more transparent. Certainly on the venture capital financing side, if we're talking about price rounds, there's the National Venture Capital Association publishes the NVCA form documents. Certainly in the last 5 years, 6 years, really seen a big push to have those be the basis most of the time for US based deals. I believe Europe's got its own set. There are, and they do sometimes get done, although they're less common, as Series Seed docs. There were some open source docs, I think last updated in 2014, seriesseed.com. You can go online, you can check all of these things out. You'll see that they are pretty exhaustive. And the diligence actually ties into the documentation process, because not only do they take a look at all of these things, but they will make you make representations in the deal documents, that is statements of fact related to those things. Again, I believe January 13th, I'm doing one on how to do venture capital financing. So if you want more detail, we can go into that. That process, I don't know, sort of takes, so if we're talking about timing, hopefully you've been out there getting a sense for and starting to build some relationships before you would even make an ask, right? So you have a sense, you got folks who are warm, where you've been figuring out where you're going to get warm introductions. And then, it might be a 6-month or a 9-month process to get to a term sheet. And then the term sheet, there'll be some negotiation. And, once that term sheet gets signed, sort of depends on your company and some other things, but I don't know, 6 weeks or so, plus or minus a couple, are sort of a typical time frame. So that's kind of how you get to that 9 months to a year now, or a year plus. Now, I've seen companies and I've worked with companies that have been able to compress all that into about 8 weeks, running a process, getting a term sheet, then getting the deal closed in 8 weeks. They're usually already have their ducks in a row and have really strong customer pull and maybe relationships with investors already. But I would not put yourself in that bucket. I think you need to build enough time, especially if you've not done this before. So we're about up, we started a few minutes into the hour. I'm going to take questions in a minute, but let me share maybe some common pitfalls. So non-compliance with securities laws, I always like to mention, you should work with counsel on any raise, okay? Because even if your company is just a small company, it's going to be subject to securities laws. And what you're going to want to do is make sure that you've found appropriate exemptions to those laws and you are, following the processes and procedures to hit those exemptions. So you don't have to either, do a registered offering, file with the SEC, which is going to be cost prohibitive, or do a rescission later, which is an offer to unwind the offering, because especially if the money's been paid back, you're not going to be able to get that done. Not thinking through regulatory issues ahead of time, not managing your cap table. So, not knowing who's on, who's off, napkin promises, not being proactive about building pro forma cap tables to understand how much of the company you're going to own at various points in time if you end up sort of on your capital raising plan. Thinking there are standard terms for anything. There's kind of a continuum of what's normal or what's market, but each deal is going to be unique. So there aren't really any standard terms. Finders is sort of another subset of securities laws. So there are a lot of people out there who will offer to introduce you to money in exchange for a cut of it or cut of equity. And many times, unless they're a registered broker dealer, it's not possible for them to do that. You potentially may need to do may need to offer your investors a right of rescission if you were to do that. So that's a problem. Side letters, these are rights that other investors will, or that your investors will ask for. They might be information rights. They might be a board seat right. They might be an observer seat right. That is the right to be an observer to the board. It might be pro rata rights. That is the right to buy additional shares in future offerings or additional convertible debt in future offerings. Especially as we've sort of seen that more and more money is being raised on safes and convertible notes, and more sort of larger institutional investors or strategics are playing earlier on. There are more and more requests for side letters. They can be done and can be appropriate when the business situation warrants it. You know, what can be really problematic is just signing every side letter that you get or trying to negotiate them. You know, negotiating side letters frequently takes a few hours of time on a lawyer's time, depending upon what's going on, unless you've really cut a standard one. And it runs up your bill pretty quickly. And then additionally, once you've got these rights out there, you got to adhere to them, their contracts. So it becomes an administrative burden. Failure to obtain corporate authorization. So if you're issuing safes or convertible notes, you should be going through the proper channels in terms of board consents and other things. And with that in mind, I know I've got a little bit more of a list, but we're about an hour in. So I'm going to take some questions and then I'll also hit maybe on some more of these. Can you provide a typical share authorized issue structure roadmap? What percentage allocated to the first two founders? Okay, so there are a couple of schools of thought on this. I mean, typically we'll see either 10 million authorized or 20 million authorized, some round number. And then usually it's sort of the authorized 6 or 7 million will get divided. Let's just take 10 million for a round number in terms of authorized. The same numbers, the same relative percentages will apply in a company where you've got 20 million. We'll typically see the founders sort of get 6 or 7 million allocated between the two. How that gets allocated is an internal negotiation and discussion among the founders. And there are resources out there, that you can read about that sort of purport to, put this input in. There's some websites where you put this input in, this input in, this input in, and it sort of tells you what you maybe should get. I can't tell you there's really any definitive guide to that. And then, typically of the remaining 3 or 4 million authorized but unissued shares, we'll see an option pool or an equity incentive plan of 1 million or 1.5 million shares put in place with another sort of 1 million or so, 1.5 million remaining authorized but unissued. And then maybe sometimes very, very early employees will receive some of those authorized shares and in the form of restricted stock, or other service providers will too. I don't really want to drill down any more specific than that kind of on this high level discussion, because each situation is going to be different and unique. But that's kind of what the common theme is. Once a founder initial 100% uses a VC and goes IPO, what is the industry founder ownership? There is no industry. It's interesting. I read some surveys. There is like no industry standard in terms of founder equity when a company IPOs. Sometimes it just depends on how much dilution they have incurred through the process. Sometimes they've got 5%. Sometimes they've got 45% or something like that. There's absolutely no standard. unfortunately, or fortunately. What is the typical equity for founder CEO? They receive common. So lots of times there's a lot of confusion out there. For most venture-backed companies, or for venture-backed companies, there's either common stock or preferred stock. That's the kind of capital stock that they have. Now, founders, advisors, consultants, the options that come out of the option pool are all tied to common stock. There is a very infrequently used type of founders preferred that was developed, I don't know, maybe around 2013 or so. I can't say I've really ever sort of seen it take off immensely. So I don't feel like this is the kind of place to kind of talk about that. I feel like that's just going to introduce more confusion. But by and large, but I do want to at least note, if you come across it, that is out there, but it's not super common. And one of the reasons why I don't think it ever became common is that I think a lot of tax people couldn't get comfortable with it and its attributes. Questions about qualified opportunity zones. You know, there was a lot of excitement about, opportunity zones. But I can't tell you that I've actually seen that be a driving factor in the venture community. So I don't have any comment on it. Yeah. There's a question about incorporating in New York and Delaware, running a luxury company. That is not going to be, I can't comment on that here. At formation, common shares are authorized. Great question. Okay. So I just talked about how at formation, there's common stock, typically 10 or 20 million shares that get authorized. Where do the Series A or Series C shares come from? Great question. So what happens is when you get to do that venture financing, there's going to be an amendment, and typically an amendment and restatement to that certificate of incorporation. And at that point, you will create the preferred stock with the attributes that you have negotiated in the deal. So that's why many times founders will say, well, I want to have X number of common and number of preferred. And get set up and say, well, we don't really know what the preferred is going to look like until you negotiate the term sheet with the VC. So that's where they come from. They get created now, and you will create them again later when you do your, your Series B and your Series C. So that's where they come from. Great question. Thank you. There's a question on costs for Series A. I think the best way to answer, the most comfortable I feel like answering it is I say it's typically 1 to 2 times whatever the investor is looking to. So as part of negotiating the term sheet, the investor will frequently negotiate to have their legal fees covered in some amount. And how much they negotiate to have covered, up to a cap, right? How much they negotiate to get covered depends on kind of where you're at in terms of your company, like how far along you are in the company, how much diligence they think they're going to need to do. It could be $15,000, could be $25,000. I've seen 75,000. I've seen 125,000. If your company side, your bill probably is going to be 1 to 2x, whatever that number is. Certainly in the Bay Area, in Silicon Valley, it's most of the times the company drafts. Outside of the Bay Area in the US, it is sort of 50-50 who drafts, which side drafts. And then elsewhere in the world, it's kind of up in the air on those deals that I've done. I will also say it depends on how much cleanup you have. So some companies, I've had companies before where it's sort of literally, previously successful entrepreneurs. They've already had introductions to VCs that's kind of just coming off of a whiteboard. Like that can get drafted really quickly and can be pretty inexpensive. So I usually try to use, rather than saying what the number is for a typical deal, because they're all different, I like to try and base it off of whatever the investor negotiates, because I think that's, probably more likely. And then it really just depends on how much cleanup you have to do. Someone's asking about recommending whether they hire a consultant to aid in the negotiation of the financiers. Again, it maybe goes to the finder's issue. I don't know enough about the situation to express an opinion. And if they are connecting you with capital and getting a chunk, or they are engaging in sort of a business of facilitating you raising capital, you got to worry about the finder issue if they're not a registered broker dealer. What's the maturity timeline for convertible securities? Great question. So safes actually don't have a maturity date. I don't know if I mentioned that before. So it's one of the great features if you're a company and you're raising capital. It's one of the scarier features if you're an investor. I think for companies and for investors, if they're using a convertible note and they're trying to set the maturity date, I think that company you need to go back to your business plan and you need to think about when you're going to be raising capital, the milestones to do it, how much you need to raise at those points, and sort of make sure you want to have some extra runway, right? Like, so if they are going to convert over in a series, let's just call it venture capital financing, you want to make sure you've at least got 6 months or maybe an extra year runway. So you got to build that in, right? So because as I explained before, it can easily take 9, 12, 18 months to raise venture capital, especially if you're just going off of a cold start. Question about VCs investing in charitable companies, 501c3. Yeah, that they don't, many times nonprofits don't have shares of stock. They've got members, or they're just run by a board. So there wouldn't be a mechanism. They wouldn't necessarily be interested in investing in that type of company. Maybe they would donate or something, or maybe, I don't, but that's not a typical target for a venture capitalist. If a convertible note is paid back to its investors, are all the equity provisions gone? So I guess the question is, I mean, it's going to depend on what the note says, but in a typical note, the note can't get paid back until maturity. And it's usually the investor or the holders of a majority of interest of investors who will get to call the note at maturity. So kind of based on those sort of that more narrow set of facts, if you've got a set of investors who have called a note at maturity and you've paid them back, typically that's it. The note is gone. It's canceled. And so all the equity provisions would be gone too. Now, again, one of the pitfalls I mentioned is that there are just no standard deals. So you got to look at the note itself. Great questions today. And thank you. Thank you for coming on this eve of New Year's Eve. Why do some people talk about pre-money valuation versus post-money valuation? Why don't we just talk about one or the other? I find this distracting when speaking about valuations. In one sense, I agree with you. In another sense, because everybody talks about it in different, like some convertible notes refer to pre-money valuation, other will refer to post-money. You just got to be fluent in both. It's taken me a while, but I'm now fluent in both, and it doesn't bother me. I will tell you, I spent a lot of time with entrepreneurs and founders explaining this and, helping them, reviewing the spreadsheets that they put together or their CFO puts together. to make sure that when we're talking about running that pro forma and what things look like at the conversion, that the model lines up with the convertible notes. But yes, I agree with you. It can be vexing that some things are done in pre-money as others in post. Any tips for valuing your company for seed investment? Again, maybe kind of getting a sense for what the market is. You know, other startups that have raised in your space, you know, if they're kind of in the same level, you know, same spot in their life cycle, you can maybe work off of comps. That can be helpful. But again, there's no, if valuation is more art than science, it is a bit of a black box in terms of what it is. And it's whatever you negotiate ultimately, especially early stage companies. All right. Great question by Anonymous, who is probably my most devoted attendee, to sort of steal somebody else's joke. Is there an IP leakage risk when communicating with VCs at the early stages? Great question. I get that all the time. Many times, especially kind of outside of like life sciences and other spaces like that, you will not be able to get VCs to sign NDAs. It's just sort of a fact of life. And honestly, one thing I always sort of think about and share with founders as they're sort of working through this issue is, even if you had an NDA and somebody were to breach it, you still got to go to court to enforce it. And do you have the resources, the financial resources to do that? So NDAs are great and appropriate in certain circumstances, but even with an NDA, best first line of defense is controlling the information that you share. You know, first maybe providing a high level, right? Not getting into the nuts and bolts until you've kind of moved far enough along in a conversation. Because it's true, VCs have portfolio companies. You know, in selecting your VC or a potential VC, you may want to be mindful. You may want to approach a VC that has made a complementary investment, not a competitive investment, right? Because there's no guarantees that that information won't kind of leak its way through. The best defense you've got is, you know, starting high level until you get far enough in the conversation that you feel comfortable. And again, if you can get an NDA and, you know, depending on your situation and it's appropriate, maybe that's helpful. But many times that's just not practicable. I'm just scrolling through to see if we can get some question about seed stage term sheets, getting both a cap and a valuation discount. You know, I have to say, I don't know what the number is, but for whatever reason, I feel like I see vast majority of seed stage deals getting both a cap and a discount. If you are a company or an investor, you know, a lot of the negotiation, especially on the cap, you know, there are a couple different sound bites or scripts that get sort of played out. One is, especially if you got a cap and a discount, the one script is, well, you got the discount. And so that's going to be a reward for taking that risk at that stage. And you'll be able to pick up additional upside or whatever when you flip over to, you know, when you convert over into the preferred equity. You know, the cap should be set at what we think that post money or whatever that future valuation is going to be. And you'll get additional upside if it turns out actually, you know, we either greatly underprice the company or those dollars that you're putting in now really make the company sort of take off. Or the other side, you know, but the other side is, well, the cap should really be what the company is valued at now. And so there's always a little bit of a tussle. You know, if you're a company side, typically it's best to not have a cap. or have it set at what you think the PostMoney is going to be, or have it set at what you think the PreMoney is going to be, or have it set somewhere in between what you think the company is worth now and that PreMoney, only because the cap effectively acts as a mechanism to juice up or increase the discount depending upon what the company is worth. But I see them in both situations a lot. A little bit about startup incubators in the VC world. Wow. 10 years gone from, I think, like no or very few startup incubators, or certainly not being a major player in the ecosystem, to just a cornucopia of them. They can be terrific in terms of helping to accelerate growth, providing feedback to startups, connections with potential investors, connections with other customers, or other players in the space, or connection to other talents. They can also be not great. It sort of just depends on the ones that you go to. Hopefully you're able to find an incubator, an accelerator that has got a good track record, and that's got relationships, that will be able to be synergistic with your startup. Yes, so this is going to be, this is recorded, and so we will be able to share it, in a week or so. Given the holiday, it might take us a little bit longer to get turned. Question about vesting and vesting agreements. So I mentioned vesting before. I feel like I feel like the common explanation of vesting is like you get your shares over time, but I feel like the more accurate way to view vesting is that, at least with regard to restricted stock for founders, is that you actually get all of your shares of stock up front. And then, but those shares of stock have strings attached to them. And as you move through time, and as vesting occurs, those strings get cut. And so if you were to leave at some point, you get to walk away with all of the shares that don't have strings attached to them anymore. I feel like that's the better way to look at it, as opposed to thinking that you're getting your shares up front. And I say that because with restricted stock purchase agreements, you do get the shares of stock up front. It's just with a substantial risk of forfeiture. That is, if you leave, you lose them. And, and when I say you get them up front, that means you get to vote them. That means they get counted on the cap table as issued and outstanding, those types of things. Now, when you've got that substantial risk of forfeiture, there's and you've got issue, there's a tax issue, which is that you get taxed when that risk of forfeiture goes away. And so there can be an issue if your company is appreciating in value, you paid 1/10 of a penny per share, but the company is now worth $1 a share. When a string gets cut, all of a sudden you're taxed on the difference between the two. That gets solved by filing an 83B election on time. So that's something always to think about and work through. And then another issue that comes up on vesting is just, when does it get accelerated? Does it get accelerated when you're terminated? Does it get accelerated, that would be like a single trigger acceleration or a double trigger acceleration? Does it get accelerated if you're terminated sort of within a window of a change of control? Also for finders, if they refer to investors, why can't we give them stock options if they are not registered brokers? Well, so if they're being engaged to connect sellers of securities with buyers of securities, and they're going to receive compensation for that, that's how they're earning compensation, then they're the definition of a broker. And so those laws are going to apply to them. So that's why. Let me just see. Do VCs fund companies if there's an acquisition or merger in the business plan? How would stock and capital be divided in that scenario? So again, to sort of It's going to depend on the VC. It'll depend if it's a strategic VC. It'll depend if it's a traditional VC. It'll depend on kind of what their investment thesis is, all this stuff. But, VCs in general, the traditional VC is looking to get a return on their capital, to get that outsized return on their capital in 7 years from when they make their investment, either because the company goes public or because there's an exit. So I think it is common, and VCs would expect to see funding of companies if there's an acquisition or a merger in the business plan. I think typically though, again, they're looking for that outsized rate of return, which is going to take a while to happen. So they wouldn't typically be expecting you, they would not typically invest in a company that's going to do an exit in a year or so. Now, maybe there's a business case to be made for it and you can get one to bite, but it's not unusual in the business plan to be like, well, we're going to grow and scale this up and then we'll sell to so-and-so, something along those lines. Because, our product will really fit in naturally with whatever they've got. And how does the stock and capital get divided in that scenario? Again, you negotiate these types of things and put a preferred stock financing agreements in place. And then, when you exit, depending on what the money gets paid out according to the preference stack, right? So first to debts and other creditors and those types of things, and then to the preferred stock, depending on the terms of the liquidation preference of the preferred stock, and then to the common. Although, if you're so in the money, it may be that the preferred converts into common and everybody gets treated equally, then everybody's happy. All right. Well, I see that we have just about hit time. So a question about how to reach me or contact me. Feel free to connect with me on LinkedIn if you just want to stay connected. If you want to partake in my office hours, feel free to send me an email at jason.gordon@klgates.com. I set those up typically Friday afternoons, although not tomorrow, from 2 to 3 Pacific. Although if you're outside of the Pacific time zone, we can find a mutually agreeable time to meet. I want to thank IDEA to IPO for organizing today's event. I want to thank each of you attendees for attending, whether you're live today or whether you are, asynchronous and, I'm talking to you from the past. And I want to thank K&L Gates for, sponsoring today's event. And with that in mind, thank you again for coming. I'm going to let you get back to building your great company. Take care. Bye-bye.